Please refer to page 3. The next topic we're going to discuss will be AS21, the effect of changes in foreign exchange rate together with foreign operations, such as foreign subsidiary and foreign associate. After looking at changes in parent interest in subsidiary, we're going to look at next topic, foreign operations. This operation can be a foreign subsidiary or can be a foreign associate. When we're dealing with foreign subsidiary or foreign associate, what should we do? Subsidiary, we have to do a full consolidations. For associate, we have to use equity method of accounting. This will still stay. Before we do a full consolidations to account for subsidy, before we apply the equity method to account for associate. For foreign operation, the first step, we must do translations before we look at full consolidations and equity method. The translation will be in accordance with HKAS 21. Please refer to page 298, AS 21, the effect of changes in foreign exchange rate. Financial statement must be prepared in functional currency. We need to know what's the meaning of functional currency, how to decide what's a functional currency. Here we have to look at the definition and the factor to consider what is the functional currency. That's the first issue. When we have foreign currency transactions, this foreign currency transaction must be reported in functional currency. When reported in functional currency, we need to know what exchange rate to use, how to account for the forex gain or loss. We need to know what is the exchange rate used to do recording, and we need to know how to account for forex gain or loss. Do we recognize the forex gain or loss in P&L, or do we recognize the forex gain or loss in OCI? This is the second issue. The third issue is, sometimes we have to do translations from one currency to another currency. For example, from currency A to currency B. Again, we have to consider what forex rates to use and how do we account for the forex gain or loss. So to answer this question, we have to ask ourselves, these translations of financial statements, is it translations of financial statements to prepare the financial statements, or translation is it because to present the financial statements? Because prepare and present will affect exchange rate and affects the forex gain or loss. That's the third issue. There are three issues we're going to address here. The first issue, we have to consider what should be the functional currency of an entity. Second issue is how do we account for foreign currency transactions. The third issue is translation of financial statements. There are two main things we consider: what exchange rate to use, how to account for forex differences. Refer to the notes next page. Functional currency is the currency of the primary economic environment in which the entity operates. Functional currency is the currency used to record transaction to prepare financial statement. Financial statement must be prepared in functional currency. Functional currency is the currency of primary economic environment in which the entity operates. We need to know what is the functional currency for the entity. Commonly, if a company operates in Hong Kong, the functional currency should be Hong Kong dollar, but it's not always true. What are the factors to consider? Is the entity considered a foreign operations? If the answer is no, the entity is a standalone entity. The entity have to identify its functional currency by considering the factors given under HKAS 21. If it's yes, the entity is considered a foreign operation. The entity have a parent company in mainland China. The company have a head office in US. This entity is a foreign operation of a head office. It's a foreign operation of the parent company. It's considered a foreign operations. Is the foreign operations and extensions of the parent or the head office? Is that considered an extension of them? If the answer is no, this entity is a foreign operation, but it's not an extension of the head office or the parent company. The entity have to decide what's its own functional currency. If the answer is yes, the functional currency of the foreign operations should be the same as its parent or head office. This is a factor to consider when decide what's a functional currency. Again, is the entity a foreign operation? No. Then you consider your own functional currency by considering the factors given under AS21. If the answer is yes, the entity considered foreign operations. Is the foreign operation an extension of the parent or head office? If the answer is yes, then the functional currency of the foreign operation should be the same as the parent and head office. If the answer is no, the foreign operation is not an extension. The entity have to decide what's the own functional currency by considering the factors given under AS21. First, we'll look at the factors to decide what's the functional currency of an entity. The factor to decide what's the functional currency of an entity, primarily we have to consider the income and the expenses of the entity. These expenses and income are mainly influenced by what currency? If these income expenses are mainly influenced by Hong Kong dollar, then Hong Kong dollar is considered the functional currency. If the main factors or primary factors cannot determine what's the functional currency, then we have to consider the secondary factors. Financing activity and how the money is retained, fund retained. These are the factors to consider under AS21. Functional currency is the currency of the primary economic environment in which the entity operates. Currency they are used for day-to-day activity. So the following factors are considered to determine what's the functional currency of entity. FC stands for functional currency. First factor to consider is the sales prices of the entity. If the sales prices of the entity are mainly denominated and settled in Hong Kong dollar, then this indicates the functional currency should be Hong Kong dollar. That means Hong Kong dollar is the currency that functionally the company use for day-to-day activity. Second factor is also relating to sales. Second factors are relating to the currency of the country whose competitive forces and regulation mainly determine the sales prices of its goods and services. Take for example, this depends on the industry that you're in. If you're in the transport industry, if you're in the industry that's providing basic utility services, normally the government do want this company to charge in local currency. The local currency will be the functional currency because that will be the currency which mainly determine the sales prices of goods and services. First two factors talking about sales prices. If 30% of your sales is in Hong Kong dollar, 30% is in renminbi, 30% is US dollar, another 10% is other currency. Then by looking at sales, functional currency may not be obvious. Then we look at the cost. Third factor is talking about the cost. Functional currency is the currency that mainly influences the labor, material, and other costs at providing goods and services. Like for example, 80% of the costs are mainly denominated and settled in Hong Kong dollar, and 20% are mainly denominated and settled in renminbi. This indicates that functional currency to be Hong Kong dollar. The first three factors, preliminary factors, the main factor to consider. In the exam, you must mention, first we must consider the preliminary factors. After considering the preliminary factors, if your functional currency is not obvious, then we look at the secondary factors. Number 4, the currency in which funds from financing activity are usually generated. Each time you issue share, you issue in Hong Kong dollar, you issue loan, issue in Hong Kong dollar. Why do you issue share, issue loan in Hong Kong dollar? Because you need the Hong Kong dollar for day-to-day activity, functionally. This is an indication that your functional currency could be Hong Kong dollar. Fifth, functional currency is the currency in which the receipts from operating activity are usually retained. Like for example, when the customer pay you in renminbi, you convert to Hong Kong dollar. When the customer pay you in Australian dollar, you convert to Hong Kong dollar. You want to keep your money in Hong Kong dollar. Why do you want to keep the money in Hong Kong dollar? Because you need the Hong Kong dollar for day-to-day activity. This indicates that functional currency should be Hong Kong dollar. These are the 5 factors to consider to decide what's the functional currency of an entity. The first 3 factors are considered as preliminary factors. After you consider preliminary factors, you can decide what's functional currency, then that's a functional currency. After you consider preliminary factors, the functional currency is not obvious, it's not conclusive, then you consider the secondary factors. After you consider secondary factors, if a functional currency is still not obvious, then ultimately the management have to decide. When the above indicator are mixed, functional currency is not obvious, the management have to use its judgment to determine what's the functional currency that most faithfully represent the economic effects of the underlying transactions. 3 factors to consider. First is the primary factors, secondary factors. After you consider the first 2, it does not help to decide what's functional currency, then the management have to come in to decide. Normally in exam, you will not come to this stage. Normally in exam, when you consider this, you should be able to know what's the answer. Now next we have to consider this additional item called foreign operation. The additional factors are considered to determine what's the functional currency of a foreign operations. Like for example, the entity have a parent company overseas, the entity had a head office overseas. It's considered as foreign operation. If it's a foreign operation, what is the functional currency of this foreign operation? Should the functional currency of the foreign operation be the same as the head office or the parent or investor? We have to consider these additional factors to consider whether is the foreign operation is an extension of the parent or the head office. Is that an extension? If it's an extension, means the parent functional currency is my functional currency. Does the foreign operation have the freedom to decide how the operations to be directed without the influence of the head office, without the influence of the parent company? Is the level of transaction between the foreign operation and head office considered as high or low? Is the foreign operation cash flow directly affects the head office or the investor? To consider all these factors. Take for example, A, set up a company B in Vietnam, 100% owned. The parent functional currency is equals to Hong Kong dollar. What is the functional currency of the Vietnam subsidiary? Should the Vietnam subsidiary functional currency be the same as the parent? Or should the Vietnam subsidiary consider its own functional currency? Is the Vietnam operation considered an extension? For example, the Vietnam operation is a production plant. Whatever they produce, 100% will ship back to Hong Kong for its own customer. What to produce, how to produce, whether to produce is based on the instruction given from Hong Kong head office or Hong Kong parent company. That is considered an extension. If it's an extension, means the functional currency of B should be Hong Kong dollar. It's part of A because that's an extension of A. Whatever B do is doing for A. Then if that's the case, the functional currency of the parent should be the same as the functional currency of the subsidiary. But what if B is an operation set up in Vietnam? Maybe 20% of the output will ship back to Hong Kong, 80% of the output to its own customer. B will operate the business independently from A. In this case, it's not considered as extension. If it's not considered extensions, then B have to decide what is its own functional currency by considering the preliminary factors and the secondary factors. If the entity is the foreign operations, if it's an extension of the entity, then the foreign operation functional currency should be same as the parent or head office. If the answer is no, it's a foreign operations, but not an extension of the head office or parent, then the foreign operation have to decide what is its own functional currency by considering the factors given under AS21. Primary, the income and expenses. Which currency that mainly influence the sales price and the production cost or operating cost? If Hong Kong dollar is the currency that mainly influence the sales prices and the operating costs, then Hong Kong dollar is likely to be a functional currency. If we consider primary factors and it's not conclusive, it's not obvious, then we consider the secondary factors. When the company issue loan or issue share, what currency they use? When we receive money from customer, they want to keep the money in what currency? These are secondary factors. Can we change our functional currency? Generally, we should not change functional currency unless there is a change in economic environment in which the entity operates. For example, in the past, substantially the sales are denominated and settled in Hong Kong dollar. over the recent year, the company sales prices, sales revenue, operating costs, 80%, 70% are in renminbi. That means there's a change in primary economic environment in which the entity operates. If that's the case, then they should change the functional currency from Hong Kong dollar to renminbi. And this change is not a change in accounting policy. This change is a change in the environment in which the entity operates as a result of the change of functional currency. For this change, we must apply the change prospectively from the date of the change. We cannot change the functional currency unless there's a change in primary economic environment which the entity operates. Can you look at a question on functional currency? Please refer to page 307. Question 10.3 is a Module A question to discuss how to determine the functional currency of foreign operations. Study the questions, understand the issue. We will discuss this question shortly. Discuss and determine the functional currency of the new subsidiary. Identify the relevant issue, provide the relevant requirement, provide relevant comment, calculation, and conclusions. 3 simple steps. Issue, requirement, comments. The issue is, what should be the functional currency of this entity? If the question talks about functional currency, you should give the definition of functional currency. But this is an 8 marks question. For 8 marks question, it must come around 8 to 9 points. If the question asks about functional currency, give the definition of functional currency. And when determining the functional currency, what are the factors that we have to consider? You have to consider primary factors and secondary factors. Then after that, you must apply to the questions. This you must apply HKAS 21. You have to consider this. We are talking about what's the functional currency of entity. Is the entity a foreign operation? If the answer is no, straightforward. If the answer is yes, is the foreign operation an extension of the parent company or investor? If the answer is yes, the functional currency of the foreign operation should be the same as the investor or parent. Foreign operations, but not extensions. Then the foreign operation have to decide what's the functional currency by considering the factors given under AS21. The discussion should be somewhere here. PHL, investment in BSC, is a new subsidiary. The functional currency of PHL is equal to Hong Kong dollar. What we have to consider is, what's the functional currency of BSC? PHL is a company incorporated in Hong Kong, is engaged in the production, distribution, marketing, and cosmetic products. PHL is considering to purchase a new subsidiary, BSC, may acquire 70%. If it's a 70%, means it's a foreign subsidiary, because located in Britain. This BSC is considered as a foreign operations. The first factors is, does the BSC should use the PHL functional currency as its own functional currency? Is that an extension? If it's an extension, then BSC functional currency should be the same as PHL. If it's not extensions, then BSC have to consider its own functional currency by considering the factors given under AS21, the 5 factors. You can refer to the notes, you can also refer to the link pad. But remember, for QP exam, although it's an open book, you cannot rely on the book, you must rely on yourself. At least 80 to 90% of the question, you must answer the question without referring to the books. BSC import most of its products from Hong Kong at a price denominated in Hong Kong dollar. The purchases in Hong Kong dollar, this indicates the functional currency may be Hong Kong dollar. But we have to consider not just one factors, you have to consider a few factors collectively to decide what's the functional currency. The first group of factors you must consider is the primary factor, the sales and the operating cost. Part of the operating cost is in Hong Kong dollar. The products is sold locally at a selling price denominated in British pound. The sales are mainly in British pound. All selling operating expenses are incurred locally in British pound. Operating expenses is in British pound. If we consider the operating costs of this entity, part of these operating costs are denominated set in Hong Kong dollar, part of this is denominated set in British pound. By considering the operating cost of the entity, the functional currency is not conclusive, it's not obvious. But when we consider the sales is conclusive, it's in British pound. This may indicate that the functional currency of this entity is British pound. Although the import cost could influence the sales prices, the selling price is mainly driven by local competitions and thus does not respond to changing exchange rate on short-term basis. Based on the primary factors, I would take it as the functional currency should be British pound. Next, we look at the secondary factors. BSC financed part of operation through a Hong Kong dollar loan from PHL, but BSC was also allowed to arrange its own funding locally, it should be in British pound. By considering the funding activity, the functional currency is not conclusive because the funding can be partly in Hong Kong dollar, partly in British pound. This is very important. BSC management operate independently from PHL while running the operation of BSC. This indicates that BSC is not an extension. If it's not extensions, that means BSC have to consider its own functional currency. You must organize your thought. For these 8 marks, first, you must mention what's the definition of functional currency, what's the nature of functional currency, what are the factors to consider when you decide a functional currency, especially for operation. Essentially, you must know how to apply the 5 factors. Okay, look at suggested answer now. Give the definition of functional currency. Functional currency is a currency of the primary economic environment in which the entity operates. It's a currency mainly used for recording transactions, preparing financial statements. If it's a foreign operations, should the foreign operation use the same functional currency as the parent? Factors that given under AS 21, 2 group of factors, primary and secondary. After considering all the factors, if the functional currency is not obvious, ultimately the management have to decide what's the functional currency that most faithfully represent the economic effect of the underlying transactions. These are the primary factors. It suggests that the BSC functional currency should be British pound because the currency in which the sales prices are usually denominated and settled. Furthermore, the question said the sales prices do not respond on short-term basis to change the exchange rate. Mainly it's determined by local competitions. This indicates that the functional currency should be British pound. When you consider the operating cost, it's not conclusive. The purchases or cost of sales is mainly denominated and settled in Hong Kong dollar, but the other operating costs are denominated and settled in British pound. By considering the factors on cost, the functional currency is not obvious. The 2 preliminary indicators overall favor British pound as the functional currency. Then after that, we may have to consider the secondary factors. Secondary factors are those factors such as the currency in which the funds from financing activity are usually generated, the currency in which receipts from operating activity are usually retained. Although BSC will finance part of its operation through a Hong Kong dollar loan, a BSC can arrange funding locally, which is denominated in British pound. This point here is not conclusive. What is the functional currency? Is it Hong Kong dollar or British pound? BSC management operate independently from the head office or parent company. BSC can retain the receipts from operating activity, normally is in British pound. And this is important, given that BSC operate independently from the parent company, BSC have to decide what is its own functional currency. This should be the first point to consider. If BSC is considered a foreign operation and extension, then BSC functional currency should be the same as PHL. But in this case, not true. BSC have to decide what is its own functional currency. Based on the analysis above, functional currency of BSC should be British pound, as the preliminary indicators are overall in favor of British pound. After deciding functional currency of entity, the next issue we have to consider is what do we mean by foreign currency? Foreign currency is any currency that is other than functional currency. For example, we have a company in Hong Kong. Obviously, Hong Kong, the local currency is Hong Kong dollar. Assuming that the functional currency of this entity is Australia dollar. Maybe this company is an extension of a head office in Australia. This company is just a branch, an extension of head office in Australia. Whatever this company do is do on behalf of the head office in Australia. The contract signed will be denominated and settled in Aussie dollar. Most of the operating costs will be paid in Australian dollar. Part of it will be paid in Hong Kong dollar. This indicates that the functional currency of this company is Australian dollar. It's an extension of head office in Australia. If the head office functional currency is Australian dollar, then this company functional currency is Australian dollar. If this company have transactions in Hong Kong dollar, this transaction is not in functional currency. As long as it's not in functional currency, it means it's a foreign currency transactions. If it's a foreign currency transaction, obviously you must apply AS21. Record or report in functional currency. In this case, the functional currency is Australian dollar. When we say report or record, the first factor we must consider is that what exchange rate to use for the recording. When record in another currency, likely there will be some forex gain or loss. The question is that this forex gain or loss, do we recognize in P&L or do we recognize in OCI? This is the issue we're going to discuss, foreign currency transactions. Foreign currency transaction means any transaction that is not in functional currency. We call this foreign currency transactions. Earlier on we discussed what is functional currency, now talk about foreign currency transaction. Foreign currency transaction must be reported, recorded in functional currency. We need to know what exchange rate to use, how to account for the differences. Foreign currency transactions. First, all foreign currency transactions are initially recorded in functional currency at spot rate. Spot rate is the exchange rate for immediate delivery. All foreign currency transactions initially must be recorded at spot rate. Take for example, initially it's recorded at maybe 1.4. Subsequently, we need to differentiate whether the item is a monetary item or whether the item is non-monetary item. Non-monetary item is other than monetary item. Monetary item, take for example, a unit of currency held. For example, cash. Cash is considered a unit of currency held. Assets to be received, liability to be paid. Essentially, it must be the number of unit of currency is fixed or can be determined. If the number of units of currency is fixed or can be determined, then we call this as monetary item. Example will be trade or loan payable. Take for example, a foreign currency loan of $50 million. We are going to pay the $50 million of interest. This item is considered as monetary item. Monetary items are those items that cash, assets to be received, liability to be settled, the number of unit of currency that are fixed or can be determined. Non-monetary items are other than monetary items. Take for example PPE, inventory, intangible assets, investment property. These are considered as other than monetary items because the number of unit currency is not fixed and cannot be determined. Settlement of monetary item must be a spot rate. This spot rate is not the spot rate at the date of initial recording. This spot rate is the spot rate at the date of settlement. For example, at the date of settlement is equals to 1.43. Initially, we recorded at 1.4, now it's 1.43. There's a difference of 0.03. 0.03 is the exchange differences. These exchange differences must be recognized in P&L. When settlement of monetary item, when there's any exchange differences, it must be recognized in P&L. If it's not settled at the end reporting period, we need to remeasure the monetary item at closing rate. The closing rate is the spot rate at the end reporting period. If it's not settled, we must remeasure the monetary item using closing rate. So assuming our closing rate is equals to 1.45. Initially it's recorded at 1.4. Now it's 1.45. There's a difference of 0.05. These differences must be recognized in P&L. Unless exception applies, this is the exceptions. We'll discuss the exception later on. Otherwise, any exchange differences on settlement monetary item will be recognized in P&L. Any remeasurement monetary item at closing rate will also be recognized in P&L for their exchange differences, unless exception apply. For non-monetary item, we have to consider this non-monetary item, is it on cost basis? If the non-monetary item is measured at cost basis, then this non-monetary item will be based on the HR rate. HR rate means the spot rate for the initial recording. For example, if this is an investment property or PPE, it's the non-monetary item. If the PPE or investment property is based on cost basis, you'll be recorded at HR rate. HR rate is 1.4. Initially recorded 1.4, now recorded 1.4. There should not be any exchange differences. If the non-monetary item is measured based on fair value basis, then we must calculate the fair value. We have to measure the fair value using the closing rate. For example, the closing rate is equal to 1.45. Initially is 1.4, now you have to remeasure using 1.45. There's a difference. This difference will be part of the gain or loss on the non-monetary item. This gain or loss do we recognize in P&L OCI depending on this item. Example, if this item is a PPE at revaluation model, the surplus will be recognized in OCI. If there's a deficit, the deficits will be recognized in P&L. If there's a differences, these differences will be accounted accordingly in accordance to HKAS 16. So if it's a non-monetary item using fair value basis, we must determine the fair value at closing rate. There may be differences, but this differences is part of the adjustment to the non-monetary item. The adjustment to the non-monetary item to be recognized in OCI or P&L, depending on the relevant standards. Refer to page 305, question 10.2, a Module A questions to discuss the accounting for foreign currency transactions. Study the questions, understand the issue. We're going to discuss this question shortly. For Part A, we are required to prepare the journal entry for the year end 31st December 2008, 9 marks. On 1st Jan 2008, RL entered a contract to purchase a printing machines for 10 million euro. The functional currency for this entity is Hong Kong dollar. This is considered as a foreign currency transactions. Foreign currency transaction must apply HKAS 21. The payment of 30% deposit was made on 1st Feb 2008 and the company received the printing machine is on 1st April. The remaining was paid on 30th September 2008 in accordance with contract. Depreciation is provided on the machinery over a period of 10 years using straight line method. For this question, we're required to do double entry. On 1st Jan 2008, they just placed the order. They have not made any payment. They have not received the machine. It's a contract to be executed. No entry is required. The entry should be made on 1st Feb 2008 when they make a deposit of payment 30%. At 1st Feb 2008, 30% paid. Remember, this company function currency is Hong Kong dollar. This transaction is in foreign currency. So it must report in Hong Kong dollar. This is a payment in foreign currency. Euro 3 mil, 30% of 10. Debit, deposit, credit, cash. Initially, this will be recorded at spot rate. Take 3 mil, multiply the spot rate on this date. On this date, the exchange rate is equals to 11.7, the spot rate. Dollar here means the Hong Kong dollar, 35.1. This is the deposit. If it's a refundable deposit, it's a monetary item. If it's non-refundable deposit, we call this as non-monetary item. Assume this is non-refundable. This will be considered as a non-monetary item. On 1st April 2008, machine received. What we need to do is very simple. First, debit the machine cost. This cost partly is the amount that we pay 2 months ago, credit deposit. We must use back the same amount because this is a non-monetary item. So if it's non-monetary item, you have to use back the same amount. It must be at the spot rate. 35.1, credit a payable in euro, 7 mil. Initially, it will be recorded at spot rate. The spot rate on this date is 1st April, 11.5. 11.5. 7 multiplied 11.5 is equals to 80.5 plus 35.1. The cost of this machine should be equals to Hong Kong dollar 115.6. This is 1st February. This is 1st April. They made a payment of 70% on 30th September in accordance with the contract. At 30th September 2008, 70% paid, euro $7 million. We have to debit the payable. The payable recorded is equals to 80.5. Credit cash, but this cash is paid in euro 7 mil. This must be recorded at the spot rate at the date of settlement. Exchange rate is equals to 11.3. 7 multiplied 11.3 equals to 79.1. There's a different 1.4. Can we look at the suggested answer now? Part A. First, we must account for payment of deposit of 30% at 1st February 2008 at spot rate. This deposit, or you can call this as prepayment, is non-refundable. If it's non-refundable, that's why we call this as a non-monetary item. If it's non-monetary item, we do not remeasure, use back the historic rate. Then we receive the machine, we debit machine equipments, credit the deposit, and we have to credit a payable initially recorded is at spot rate. The total cost of the equipment machinery is equal to 115.6. Then the settlement of this payable is a monetary item. Settlement will be at spot rate at the date of settlement. In this case, there's exchange differences of 1.4. So these exchange differences will be recognized in P&L because these exchange differences arises from settlement of monetary item. For the year 9 months, we must account depreciation based on cost over 10 years. Debit depreciation, credit accumulated depreciation of credit equipments. All this, you get the 9 marks. In the exam, you have to come up with the description. If the question asks for journal entry, do not just debit and credit. You must tell the marker what is this entry for. You have to give a simple description. That's all for part A. For this question, I'm using figures journal entry to discuss the basic requirement, the general principle of the relevant standards. From the calculations, journal entry, working, after having good understanding of the requirement of the relevant standards, in the exam, you are able to offer comments, advice, explanations as required by the questions. Bear in mind, you must put those figure journal entry in sentences for examination purposes. Please refer to page 311, question 10.5, and other module A questions to discuss the accounting for foreign currency transactions. Study the questions, understand the issue. We're going to discuss this question shortly.